The Silent Revolution. How Wall Street discovered what retail still doesn't understand about XLM. Picture this. It's 3 a.m. on a Tuesday in June 2025, and I'm staring at my screen watching something that shouldn't be happening. Stellar Lumens, that forgotten altcoin from 2017, just processed a $52 million institutional liquidity injection from Singapore. No fanfare, no Twitter announcement, just quiet, methodical capital deployment that most retail investors completely missed. Here's where it gets interesting. That moment crystallized something I've been tracking for months. While everyone was chasing the latest meme coin or arguing about Bitcoin ETFs, the smartest money in the room was quietly positioning around infrastructure tokens that actually solve real-world problems. And XLM, it just became the poster child for this invisible wealth transfer.
Don't forget to support the video with a like, because it supports us a lot and helps us reach other people and help them learn important information.
Let me tell you why this matters more than you think. The infrastructure play nobody saw coming. You know what's fascinating about working in financial technology for the past decade? I've watched every supposed revolution come and go. But what's happening with Stellar right now isn't a revolution, it's an evolution. And the difference matters enormously. Think about this. While retail traders were busy watching Dogecoin and waiting for the next pump, Stellar quietly onboarded Franklin Templeton's $580 million tokenized treasury fund. PayPal integrated PYUSD on Stellar for cross-border remittances. MoneyGram expanded its network to process $1.5 billion in remittance volume through Stellar Rails. These aren't speculative bets, they're infrastructure deployments. I remember having coffee with a treasury manager from a mid-sized fintech last month. She told me something that stuck. We're not looking for the next 100x token. We need rails that can process $50 million in daily settlements without breaking, with fees under a penny and compliance baked in. That's when it clicked for me. The narrative had fundamentally shifted from speculation to utility. Smart money recognizes what retail doesn't. Utility-driven adoption creates sustainable value. The research documents I've been analyzing reveal something remarkable. Stellar processed 471.2 million operations in Q1 2025 alone, with average transaction costs of $0, 0.00015 and 5.84-second settlement times. But here's the kicker. Over 60% of that volume was stablecoins like USDC and EURC, indicating real money movement rather than speculative trading. The Sorobon revolution. Why smart contracts finally matter. And here's where it gets wild. Remember when everyone said Stellar was just a payments network? That narrative just died. The launch of Sorobon smart contracts in March 2024 wasn't just a technical upgrade. It was Stellar's transition from a one-trick pony to a full-stack financial infrastructure platform. I had the chance to speak with a developer at Palago Labs, the Vancouver-based fintech that's tokenizing invoices for supply chain finance on Sorobon. He explained how their platform lets SMEs convert accounts receivable into liquid tokens, providing working capital in hours instead of weeks. They've already facilitated over $1 million in USDC loans. This isn't theoretical DeFi, it's real businesses solving real problems. The $100 million Sorobon Adoption Fund has supported over 160 projects. But here's what caught my attention. These aren't yield farming protocols or NFT marketplaces. They're building invoice tokenization platforms, automated payroll systems, and compliance tools. The focus on financial infrastructure over speculation tells you everything about where this ecosystem is headed. Protocol 23 just changed the game entirely. Scheduled for mainnet vote on the 26th of August, 2025, this upgrade introduces parallel execution of smart contracts, unified asset events, and state archival features that could boost throughput to 5,000 TPS. When I think about scalability, I don't think about theoretical benchmarks. I think about whether the network can handle a Treasury Department processing $100 million in daily settlements. Protocol 23 gets us there. The institutional awakening, following the smart money. This might blow your mind, but the most telling sign of Stellar's transformation isn't the technology, it's the money. And I'm not talking about retail FOMO. I'm talking about institutional capital that moves in $100 million increments and doesn't make mistakes. The research shows large wallets holding 1 minus 10 million XLM increased by 37% over 90 days. These aren't retail traders buying the dip. This is sophisticated institutional accumulation during a period when most people weren't paying attention. Smart money doesn't accumulate garbage, they accumulate infrastructure. I've been tracking Franklin Templeton's move since they first tokenized assets on Stellar. Their expansion into European markets with a Luxembourg-domiciled tokenized UCITS fund represents something unprecedented. The first fully tokenized treasury fund available to institutional investors across 8 European countries. When a $1.6 trillion asset manager chooses your blockchain for their most regulated products, that's not an experiment, that's institutional validation. Let me break it down with some numbers that should terrify Ethereum maximalists. Franklin Templeton reports processing 50,000 transactions through traditional systems costs $50,000. The same volume on Stellar costs $12. With potential savings of $200 million annually, the business case for Stellar adoption becomes undeniable. But the real validation came from an unexpected source: Visa. In July 2025, Visa integrated Stellar into its stablecoin settlement platform alongside Ethereum and Solana. When Visa, the company that processes $14 trillion annually, chooses your network for settlement infrastructure, you've officially graduated from altcoin to financial rails. China's digital yuan strategy. The geopolitical chess game. Here's something that kept me up last night researching. China's digital yuan expansion isn't happening in isolation. The People's Bank of China established an international operations center in Shanghai with explicit goals of creating a multipolar currency system that reduces dependence on the US dollar. Now, pay close attention. This creates massive demand for interoperable blockchain solutions that can bridge different digital currencies and payment networks. XLM's ISO 20022 compliance positions it perfectly for this role. When 80% of global transactions migrate to ISO 20022 by 2025, compliance becomes a prerequisite, not an advantage. I found fascinating research on China's CIPS 2.0 system, which processed 175.49 trillion yen, $24.47 trillion, in 2024 across 189 countries. As this system expands, it needs bridge currencies for cross-border settlements. XLM's neutral positioning and compliance features make it a natural candidate. The geopolitical implications are staggering. We're witnessing the construction of alternative financial infrastructure designed to operate independently of traditional Western systems. XLM isn't just positioned for this transition, it's essential to it. The network effect acceleration. Why timing matters. Coming up, the regulatory development that changes everything. While researching European regulatory frameworks, I discovered something remarkable. The EU's Markets in Crypto Assets Regulation, MiCA, has created unprecedented clarity for blockchain-based financial services. European financial authorities now recognize Sorobond-based smart contracts as legally viable tools for cross-border payments and trade finance. This regulatory clarity is creating a competitive moat. While other blockchain projects still navigate legal uncertainty, Stellar operates within established frameworks. Projects building on Stellar can offer regulated services in Europe, while competitors face geographic restrictions. I interviewed a fintech executive in Amsterdam who explained how MiCA compliance influenced their platform choice. We evaluated Ethereum, Solana, and Stellar for our tokenized invoice platform. Only Stellar offered the regulatory certainty we needed for European operations. That's the network effect in action. Regulatory clarity driving developer adoption, which drives user adoption, which drives institutional adoption. The network metrics validate this thesis. Stellar reached 11.28 million total accounts, with 10.29 million monthly active accounts, plus 28% quarter over quarter. But more importantly, 94.6 million on-chain payments represent sustained business usage rather than speculative trading. The real-world asset revolution, beyond the hype. The implications are staggering. Stellar has quietly become the third largest blockchain for real-world asset tokenization, hosting $475 million in tokenized assets. This positions XLM ahead of Solana and demonstrates institutional confidence in the network's infrastructure. The Stellar Development Foundation projects $3 billion in real-world assets by 2025, a 10x increase from 2024. But here's what makes this different from typical crypto promises. It's already happening. Paxos, Arundel Finance, Etherfuse, and SG Forge have launched institutional tokenization offerings. These aren't pilot programs, they're production systems processing real institutional capital. I spent time analyzing the tokenized asset flows and found something remarkable. Unlike speculative DeFi protocols, these assets represent genuine institutional deployment. Tokenized treasuries, corporate bonds, and commodity baskets create sustained demand for XLM as the native settlement asset. The invisible accumulation zone, positioning for the breakout. Now, here's the twist. We're currently in what technical analysts call an accumulation zone. XLM has been consolidating between $0.39 to $0.43, showing classic signs of institutional accumulation rather than retail speculation. Low volatility, narrowing Bollinger Bands, and steady volume indicate smart money is positioning for the next move. I've seen this pattern before. Remember Ethereum in 2019? The same quiet accumulation, the same institutional partnerships, the same fundamental improvements happening below the surface. Then the DeFi summer hit, and everything changed. The catalysts for XLM are even stronger. Protocol 23 activation, expanding institutional partnerships, and regulatory clarity create multiple paths to repricing. When institutional adoption reaches critical mass, network effects compound exponentially. Conservative price targets range from $0.40 to $0.87 for 2025, with optimistic scenarios reaching $1.44 based on continued institutional integration. These projections reflect fundamental analysis rather than technical chart patterns. As more institutions deploy Stellar infrastructure, XLM demand increases proportionally, while supply remains fixed. The tokenomics revolution. Why supply and demand matter. Light bulb moment. Understanding XLM's value proposition requires understanding its tokenomics. The 2019 token burn eliminated 55 billion XLM, 52.4% of original supply, creating scarcity dynamics that most investors ignore. With only 31.2 billion tokens in circulation from a fixed maximal supply of 50 billion, every transaction creates deflationary pressure. But here's the beautiful part. XLM isn't just a speculative asset. It's operational infrastructure. Every Soroban smart contract execution requires XLM for gas fees. Every account requires minimum XLM reserves. Every cross-border payment uses XLM for settlement. Usage drives demand while supply remains fixed. That's Economics 101. The final verdict. Infrastructure over speculation. After months of research, dozens of interviews, and analyzing terabytes of on-chain data, my conclusion is simple. Stellar represents the future of financial infrastructure, not cryptocurrency speculation. Here's the kicker. This isn't about getting rich quick. This is about positioning in the infrastructure that will power global finance for the next decade. When traditional financial systems buckle under trillion-dollar inefficiencies, blockchain networks that solve actual problems capture disproportionate value. The evidence is overwhelming. Institutional partnerships with Franklin Templeton, PayPal, and major payment processors validate network utility beyond speculation. Real-world metrics demonstrate sustainable growth. $475 million in tokenized assets, 471.2 million quarterly operations, and expanding enterprise adoption. The question isn't whether blockchain technology will transform global finance. That transformation is already underway. The question is, which networks will capture value as traditional financial institutions modernize their infrastructure? Based on every metric that matters, regulatory compliance, institutional partnerships, technical performance, and real-world adoption, Stellar is positioned at the center of this evolution. So here's my challenge to you. Are you going to wait for mainstream recognition when prices reflect full adoption? Or are you going to position yourself now while institutional money is still accumulating and retail hasn't caught on to what's happening behind the scenes? The infrastructure revolution is happening. XLM isn't just participating, it's leading. And if you're not paying attention, you're missing the biggest wealth transfer opportunity since the internet went mainstream. Smash that like button and subscribe because this infrastructure transformation is just beginning, and you don't want to watch it from the sidelines when the real breakout starts.